Did you know that if you start investing at 18 and save just $5 a day, by age 65, you could have over $700,000? Sounds crazy, right? But that's the power of compound interest, the magic that makes your money grow faster over time. Yet, most teens are completely missing out on this opportunity. Here's something even more shocking. 60% of people in their 20s don't have a single dollar invested in the stock market. That means they're missing out on the huge returns that can turn small amounts of money into big wealth. If you start early, you can build a fortune before you even hit 30. But how do you begin? And what if you don't have a lot of cash? Don't worry, you don't need thousands of dollars to get started. In this guide, we'll show you how to turn just a few bucks into a serious investment portfolio. In the next chapters, we'll break down the simple strategies to start investing even if you're still in school. From the best apps to use, to how to pick stocks, and which new trends to watch, this isn't about getting rich quick. It's about setting up your future with smart, steady moves. Ready to learn how to make your money work for you? Let's dive in and get started. Chapter 2. Money Talks. Why start investing before 20? Investing young isn't just a cool idea, it's a game changer. Did you know Albert Einstein called compound interest the eighth wonder of the world? He said, "He who understands it earns it, he who doesn't pays it." That's why starting early matters. Imagine you invest $1,000 at age 18 with an annual return of 8%. By 65, it grows to over $50,000. But if you wait until 30 to start, that same $1,000 only becomes $16,000. Time is your secret weapon. Another perk? Teens can take more risks. Why? You have years to recover from mistakes. While adults worry about mortgages and retirement, you have the freedom to experiment and learn. Use your age to your advantage. Start small with money from birthday gifts or part-time jobs. Even $10 a week can grow into thousands. Apps like Acorns or Robinhood make it super easy to start. Here's a surprising stat: 1 in 5 teens in the US are already investing, according to a 2023 survey. If they're doing it, why can't you? You don't need to be a math genius. You just need consistency. Investing isn't just about money, it's about habits. Teach yourself to save a portion of every dollar you get, even if it's just 10%. Over time, that discipline pays off big. Chapter 3. The $5 Blueprint. Investing without a big budget. You don't need to be rich to invest. In fact, most millionaires start with small amounts. Here's an example. Warren Buffett bought his first stock at 11 years old, using just a few dollars he earned delivering newspapers. Today, platforms like Stash, Fidelity, and M1 Finance let you start investing with $5 or less. Fractional shares are a game changer. Don't have $3,000 to buy an Amazon stock? No problem. Invest $10 in a slice of it. One smart strategy is dollar cost averaging. It's simple. Invest the same amount regularly, no matter what the market does. This approach reduces risk because you're buying more shares when prices are low and fewer when they're high. Over time, it balances out. Think long-term, not short-term. Studies show that holding investments for 5 years or more outperforms short-term trading 94% of the time. So, don't panic if prices dip. That's normal. Stay consistent. Remember, knowledge is your best investment. Read books like The Simple Path to Wealth by J.L. Collins or I Will Teach You to Be Rich by Ramit Sethi. They're easy reads packed with practical advice for beginners. Lastly, avoid lifestyle inflation. As your income grows, don't spend it all. Invest that extra cash instead. Fun fact: people who invest at least 20% of their income are 3x more likely to achieve financial independence before 40. Be one of them. Want more investing tips and tricks? Don't forget to subscribe to stay updated on future chapters where we break down how to master your money. Chapter 4. Mind over Money. The psychology of smart investing. Investing isn't just about numbers, it's about mindset. One of the biggest mistakes new investors make is letting emotions drive decisions. Did you know that according to a Dalbar study, the average investor underperforms the market by about 4% annually due to emotional trading? Fear and greed can wreck your portfolio. First rule: stay calm. The market will go up and down, that's normal. Warren Buffett's advice? Be fearful when others are greedy, and greedy when others are fearful. In simple terms, don't panic when prices fall or jump into hype just because everyone else is. Another critical tip: avoid FOMO, fear of missing out. That meme stock everyone's talking about? It might crash tomorrow. Focus on your long-term goals instead. Set realistic expectations. You're not going to double your money overnight. Studies show that slow, steady growth wins the race. Think of investing like planting a tree. It takes time to see the fruits. Know your why. Are you investing for college, a car, or long-term wealth? Having a goal keeps you focused and less likely to make impulsive decisions. Here's an exercise. Write down your investing rules. For example, I will invest 15% of my income monthly and hold stocks for at least 5 years. When emotions take over, these rules will guide you. Lastly, educate yourself. Read books like The Psychology of Money by Morgan Housel. He explains why patience and discipline are more important than math when building wealth. One standout quote: investing is not about making money, it's about staying invested. Chapter 5. DIY Wealth. Building a portfolio that matches your vibe. Your portfolio should reflect your goals and personality. Are you a risk taker? Or do you prefer playing it safe? The key is balance. Start with asset allocation. This means deciding what percentage of your money goes into stocks, bonds, and other investments. A simple rule of thumb is the 100-age rule. If you're 18, keep 82% in stocks and 18% in safer assets like bonds. Diversify to reduce risk. Don't put all your money in one stock. Use ETFs or index funds to spread your investments across hundreds of companies. Vanguard's S&P 500 ETF is a great beginner option. It mirrors the performance of the US stock market. Think beyond traditional stocks. Interested in tech? Look into companies working on AI, robotics, or renewable energy. These industries are projected to grow massively in the next 20 years. Want to invest with your values? Try ESG, environmental, social, and governance funds. They focus on companies that prioritize sustainability and ethics. For example, Tesla is a popular pick for ESG investors. One unique idea: consider REITs, real estate investment trusts. They let you invest in real estate without buying property. Some REITs focus on shopping malls, while others specialize in data centers or healthcare facilities. Another tip: rebalance your portfolio annually. If your stocks grow faster than your bonds, shift some money to maintain your original percentages. It's like a financial tune-up. Finally, remember that investing is personal. There's no one-size-fits-all. Experiment, but stay informed. As Benjamin Graham, the father of value investing, said, the individual investor should act consistently as an investor, not as a speculator. Chapter 6. Future-proof. Investing in trends that shape tomorrow. Investing is more than numbers. It's about spotting opportunities. Think about the future. What industries will dominate in 10, 20, or 50 years? Align your investments with those trends. Green energy is a big one. The International Energy Agency predicts that renewable energy will supply 90% of global electricity growth by 2050. Companies in solar, wind, and electric vehicles, EVs, are worth watching. AI and robotics are booming too. According to Grand View Research, the AI market is expected to grow by 37% annually through 2030. Companies like Nvidia and Microsoft are already leaders in this space. Space exploration is no longer science fiction, it's big business. With NASA and private companies like SpaceX driving innovation, investing in aerospace could be huge. ETFs like ARK Space Exploration focus on this sector. Healthcare is another steady bet. As populations age, demand for medical advancements will skyrocket. Biotech companies working on cancer treatments or gene editing have massive potential. Stay curious. Read about trends in tech, sustainability, or even gaming. For example, esports generated over $1.38 billion in 2022 and is growing fast. If you're passionate about something, research its investment potential. But remember, not all trends are gold mines. Cryptocurrency and NFTs exploded, but many investors lost money chasing hype. Before jumping in, ask, is this backed by real value or just speculation? Finally, keep learning. Follow industry news and listen to experts. As Peter Drucker once said, the best way to predict the future is to create it. By investing in the right trends, you're shaping not just your portfolio but the world. Don't forget to subscribe for more on how to future-proof your wealth and build a smart, sustainable portfolio that grows with you.